Hello, everyone, and welcome to the August 2025 IndiView Market Insights. This is the monthly update and outlook piece. I am Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to have a conversation about just kind of a status update on what's happening in the markets. If you tuned into our last one, on the quarterly one, we're going to have a more robust look at what's going on in the economy, what's going on with markets, and just our thoughts and views. Here, we're going to provide more of an update where we are in the markets for the year to date and other time frames, and then also just some update on our outlook and positioning. So let's get going. So let's talk about asset class performance year to date. We're still in the green. For the most part, things are still pretty positive, despite all the rhetoric out there, despite all the negativity and all the hemming and hawing about what's going on in Washington, what's going on, with tariffs, taxes, all that fun stuff. The market has generally looked through most of that stuff, and we're still positive under most asset classes. S&P 500 is up nearly 7% year to date. And you can still see international markets have still been relatively strong. So overall, it's been pretty good. Bonds, even, if you look at the bonds, the fixed income market here up 4.6% year to date. That is not bad at all, considering the volatility that we've had, especially around the thought process of what tariffs are going to do to the economy, what interest rates are supposed to be doing from that perspective. Bonds have held up pretty well. 4.6% for, a little past the halfway point in bonds. That's pretty good. That's honestly decent for a year for bonds. So we're on good track right now in the bond market as well. One quick highlight here is the US dollar rebounded a little bit this month, but it's been down for the most part in the year. Is that people have, worried about the economy and that kind of stuff, and it's had a negative dollar impact. But if you look at the alternative currencies, what I would call them is gold and Bitcoin. Boy, they're still buying that. Both are up around 25% year to date. That is substantial performance. There's no question about it. If you know me, I don't invest aggressively into alternative currencies. I like things that provide, recurring income streams and cash flow. Neither of these do that. This tends to be a market of what will the next person pay me for it. But it's been undoubtedly a strong market this year, and honestly last year as well. From the perspective of just looking at their performance has been good, but also there's just been natural buyers, right? Whether that's the US government, whether that's foreign governments, there's been a natural demand for increasing gold and Bitcoin. How long that lasts, I have no idea. But right now, those performance numbers, I can't argue against them. They've been very strong. And I think the component of having alternative currencies to the US dollar plays a little bit in that as well. So apologies in advance for the eye chart here. It's somewhat difficult to see, but I'm just going to talk about some of the highlights of a lot of different asset classes here and a lot of different performance numbers. But I just want to kind of highlight a couple of them. Is that July was still relatively strong, even though we kind of ended on a difficult week. The market was up almost across the board. The stock markets was up almost across the board, with the exception of Europe. That had a difficult month, but outside of that, still pretty strong. What I want to tell you is a little bit of seasonality. Now, I'm not a huge believer of seasonality. I'm certainly not a believer of sell in May and go away and that stuff. But I do like to take a look at what seasonality historically has provided. And I think the biggest thing that I'm paying attention to right now is if you look at just history of the S&P 500 over time, broken down by month, August and then September tend to be our weakest components. There's a lot of different arguments for it. I think political has been an argument in the past, and the effect of people start getting nervous about the election cycle coming up, and that happens frequently around those times. People coming back from the summer, I don't know how much I believe in that one. But just looking at the data in and of itself, August and September tends to be the weakest time of the year for the market. Not every year. It's certainly not every year in July. It's not a sell in July and fly back in September. I don't know a good one for that, but I would not put any investable criteria on this and or any investable action on seasonality of a month by month perspective, but just understand that historically these have been waning months. And so, the market, especially near all-time highs at this point right now, and surprisingly resilient, I would say, has been, some of the sentiment out there. Frankly, if you look at earnings have been pretty good. So that sentiment is, if you go with sentiment to earnings, it's actually not that surprising. But sentiment to all of the other stuff that's been happening, especially tariff oriented stuff that's been happening, I think people are a little surprised, especially given April, that the market has rallied so aggressively subsequently. But just be prepared that this could be a seasonally weak period that we're entering into right now. One of the things I saw on here is that the 3-month US Treasury right now is yielding more than the 2-year Treasury and the 10-year Treasury. So right now, ultra short-term rates are still higher than you can get by taking 2 and 10 years worth of risk out there. Now, again, US Treasuries tend to be what the closest proxy thing we have to risk-free. It's certainly not completely risk-free, but it's the measurement stick that we use. But again, you're supposed to get paid for taking on time risk too, right? And 2 years is longer than 3 months, and 10 years is certainly longer than 3 months. And right now, you're not getting paid to do that. And so where we see that is saying, basically, right now, take advantage of that, right? Enjoy the income that comes from that. We'll see what the Federal Reserve does in the coming months. There's an expectation in September of a cut right now. I looked at the CME report. And as of, I believe, Friday, it's an 85% probability of a Fed cut in September, which is very different than what we've seen here recently. We've been talking about 1 to 2 cuts on the year, but they've been delaying those towards the end of the year. Well, we're getting closer to the end of the year, and now the market is saying we expect a cut. We'll see. It could absolutely happen. In that case, the 3-month Treasury probably comes down as a result of that. We'll see what that does to the 2 and 10 year. Those aren't perfectly correlated, but it is pretty strongly correlated with the 3-month Treasury. So those numbers may be coming down, but right now, I think this goes to and I'll talk about this in the outlook a little bit more, is I just don't believe that there's a ton of incentive of taking aggressive time risk, and especially aggressive default risk at this point. Take the component that you're getting that's relatively safe from that higher yielding short-term stuff right now. And then as the Fed cuts, we may have to make adjustments to that, or just lower the expectations of what we're going to expect from our bond returns going forward. So there's a component of both that you have to do in there. But right now, I would say that, investing at that short end and getting that yield that's actually higher than the longer end right now is actually worth it. So that's where we would be positioned. Turning to the sector performance, one of the things that surprised me is that industrials is actually the strongest performing sector on the year. I looked into it a little bit more because I was surprised because, again, tariffs tend to be goods focused and industrials tend to be goods focused. And when you're goods focused and your input costs are rising and you don't know where they're going to end up and all that stuff, I was surprised that this is the strongest performing sector. So I wanted to look into it. And the 2 GE companies, Uber and RTX, are having very strong years, and they also tend to be pretty high weights in in the industrial sector. So because they're pretty big within the industrial sector and they're having very good years, that is propelling the industrial sector higher. GE's performance, again, is probably around power generation, the AI type of front, and just frankly, them executing. The GE is a company that was lambasting for a long time, but over the last 1.5 years, 2 years have really found their stride, especially as split up companies, to where they've been really doing well and really being rewarded by the market for doing well. Uber, I think, is a little bit of a surprise that it's even in industrials. You could argue it's more of a technology company. You could argue it's a consumer company. It's in industrials from the sector perspective, and it's had a very strong year. And so that's propelled the industrial sector higher. Lastly, RTX might be a little bit surprising considering the thought of defense cuts and the thought of aerospace, lower travel, all that stuff. RTX is still performing pretty well on the year. And so it's a company that is also propelling the industrial sector higher. Last thing on the right, on the bottom right, is commodities and currencies type of approach. I don't usually spend much time on currencies, to be honest with you. It's difficult to predict, it's difficult to fluctuate, it's also difficult to really assess. I do look at what the US dollar is doing because it affects so many companies, but I don't really pay too much attention to those currencies, those other currencies as well. But I do want to look at oil, and that oil did have a pretty substantial rebound in July. We're still down. I mean, the energy companies really didn't benefit that much from it. They were okay, but it's not like we saw a massive re-rally. But that's what you need to pay attention to, is oils can be very volatile. And especially it's kind of an economic sentiment indicator, but it also has supply demand issues. So there's a lot of inputs that go into oil, but remember, oil goes into gas, which then is acts basically as a consumer tax. So when oil prices are down, consumers tend to have more to spend because you're not putting as much into your car as you were. You're putting the same amount of gas, but you're getting it for cheaper. And it also acts a tax the other way. So that acts as a little bit of a tax cut, but it also acts as a tax gain when the prices are going up. I think we're in fine territory right now. There's no sense that this is going to hamper the economy. In fact, we were pretty low before. Now we're rallying off those lows. We are not in danger territory in oil by any stretch of the imagination right now, but it's something to pay attention to, that if those numbers continue to rise up, it does act as somewhat of a consumer-based tax, because you're spending more on the things you need to spend on, which gives you less money than the things you want to spend on. So we're keeping an eye on that. One of the things I like to do here at Indie Wealth is give you the path forward, just what our outlook and positioning are. Again, we don't do predictions as much. We don't do a lot of the S&P 500 will be here and interest rates will be here. We're going to tell you where we think those things are going to wind up from a perspective of just saying, hey, now is the time to maybe take a little more risk, a little less risk. But one of the things I like to do is we're going to do that on a quarterly basis. But during those quarters, in the intra period, like we are right now, I want to give you just some updates. I really want to kind of keep a scorecard of this, because, these predictions, again, this is why I don't like predictions, is that when people are right, they tout them to the rooftops. When they're wrong, they try to ignore them as fast as possible. And no one really knows that well. So just stay out of the prediction game. But from our perspective, our outlook started, will political noise reduce? Not likely. The update here is it didn't reduce at all. In fact, it probably amped up a little bit in the last month. So I don't expect this to change really at all. I think this is just what we're going to have to live with for a while. The market has seemed to start tuning the noise out a little bit. We'll see if that continues. Really, again, earnings have been relatively strong. We're at, based upon Q2 earnings, it's 10% year-over-year growth. That's not bad at all. So if the earnings can keep up, it may give benefit to tuning them out. But if things like jobs start to weaken, U.S. economic growth starts to weaken, I think there's more of a negative skew on this, which I'll talk about here in a minute with regard to tariffs and trade. The Fed will cut at least once this year is the prediction I made. That, I guess you could call that a prediction. I think that's probably our most likely scenario. I think, we haven't seen a cut yet. I think the jobs number probably changes that, unless they start to get some evidence that tariffs are really having a negative influence on inflation. I do think we're at that 1 to 2 job cuts, or 1 to 2 Fed rate cuts scenario. I think we're nearer and then further away. I think September, again, September, this isn't a hero stance. There's an 85% probability right now of a September cut. I think that's actually accurate, unless we start to see evidence of re-aggressive inflation. That's going to give them pause. They may have to hold off for a little while longer. Again, trade deals, I said before that I think they're going to have less and less influence on what happens in the markets. I'm going to change that a little bit in the effect of I don't think it's a driver of positive market trends going forward. I think it can hold up, and that if other trends are going well, the market will do fine. I do think it has a negative skew, that if this just continues to escalate on itself and we do start to see some influence of behavior on that, whether it's job numbers coming down, whether it's companies saying margins are going to be hurt, or whether it's just the consumer giving you a signal and saying, I can't take this stuff anymore. I think this has a negative skew, is that I don't think it's a real good positive driver, but it could force us to seeing that correction. The seasonality approach of that August, September, this could be a driver of that. If we're seeing escalating tariffs and penalties and all the other stuff that's coming through that, and then we start to see it in the economic data, I do believe this could have a negative skew. I don't see it as much of a positive driver. Again, we've recovered back to all-time highs. Not a reason to sell. That's absolutely consistent. Remember that we are in a historically weaker season, August and September. It's not really a reason to sell. Don't use that as a reason to sell out of the market, but it may be a reason to, again, recalibrate risk a little bit. We've had a really strong market. We are near all-time highs. You don't need to pull back risk completely, but you need to understand where you are and making sure that you're not aggressively chasing risk going forward. And that rolls right into our position. I don't think that, in our positioning, excuse me, I still don't think there's real reason to chase risk at current levels. And given the recent jobs data, I would say that it's more likely to be at equilibrium to maybe even slightly below equilibrium at this point right now on the risk level. And the reason I say that again is I believe jobs and job sentiment is one of the biggest components of the US economy. And we're clearly seeing evidence of weakening in there. It's not contracting. It's one data point that fell, but we were decelerating before. And then this one was a pretty big step down from that. If that continues to be the trend going forward, I would say we want to be probably a little more conservative than our standard risk would be, rather than chasing risk at current market valuations. On the fixed income side, the update again, I think short maturity, low risk bonds are still fine. 3-month treasury is paying more than your 2 and 10 years. You're getting pretty good yields without taking a whole heck of a lot of risk there. We'll see what the Fed does, the Fed interest rates. If they start cutting that, that yield will start to come down. But at current levels right now, I would still hold there. I just don't think there's a lot of incentive to taking time nor default risk at this point right now. I think it's fine to just stay in that low end and just generate the yield until you start to see a change that degrades that. On the stock side, one of the things, I'm going to say when I'm right, I'm going to say when I'm wrong. And I was clearly wrong here on this month. We'll see if I'm wrong going forward, but wrong and early can often be mixed with each other, but pretty much the same result. So it doesn't really matter that much anyway. But from healthcare's perspective, healthcare was one of the weakest performing sectors. It continues to be weak. United Healthcare, which is a stock we own in our Indy stock portfolio, has been terrible this year. There's no other question I can give you, or no other answer I can give you there. It's been awful. We have not sold it as of yet. We're in reviewing mode. We think that's over aggressive selling, which happens from time to time, but we don't know the exact way out of this thing yet, because, it's always had a premium valuation to its peers. And so now it's more in line with them, which doesn't suggest that it may re-rally aggressively. It's not like it's so cheap that, it can't do anything. It could stay here for a while in the penalty box. And other healthcare companies just have not been terrific. And the sector continues to be weak. I still think, just given their growth profile and the valuations of them, it's still relatively attractive. But I could be wrong on the sentiment, in that people are just saying, I just don't want to deal with it right now. That could absolutely happen through the remainder of the year. International stocks, IFA, or mostly Europe, honestly, waned a bit. But international is still leading overall. So from a market perspective, that is, they've been strong after several years of underperformance. So understand that US investors are still probably pretty underweight this stuff, because it needs to be a real show me story. And to be honest with you, there isn't a terribly great catalyst outside of saying, for emerging markets, maybe if we have a weaker dollar going forward. That could be a component where emerging markets continue to rally. The other argument is certainly valuation, where US stocks are pretty expensive and international stocks are not nearly as expensive and could be described as cheap in certain scenarios. I think that's an argument that people have used to their own failing over a long period of time. There tends to need to be a catalyst to get people investing into it. There's not a great one right now, but we would say that you still want to have international exposure because, again, these things can move at a glacial pace, and international stocks have been terrible for years. I still think there's positioning to have that and an answer from a diversification perspective. And if you had that diversification coming into the beginning of the year, you'd have been rewarded for that. So that's our monthly market update and outlook piece. I hope you like the updates component. That's something we'll do going forward. And then on the quarters, we may give a more robust. And then certainly at the beginning of the year, we'll kind of give our broad-based outlook. So that's the trajectory of the monthly. I hope you enjoy this. If you do, please like and subscribe and visit us at Indie Wealth Management and contact us if you need anything. Until then, thank you very much and take care.